Okay, coming down the home stretch. Last week was the tough week. It is now downhill now. We have some easy stuff this week. We're going to talk a little bit about capital structure and a little bit about cash flow and so on. But it's downhill now, so you should be feeling really good about how far you've come. So first thing we're talking about is capital structure. So capital structure is the value of the firm is defined as the sum of the value of the debt and the sum of the value of the equity. In this case, we've shown them as stocks and bonds. Value of the equity is stocks, value of bonds is the value of the debt, and the goal of the firm's management is to make the firm as valuable as possible. Then they should pick the debt to equity ratio that makes the pie as big as possible. So there's some factors here that they have to consider. How much should they borrow? How much of the firm should be borrowed money? And how much should be investors or owners money put in? So imagine this in a small business. You're a small business, you're going to start a restaurant. And how much of your money you're going to put in and how much you're going to take from the bank. That's the debt to equity ratio. So if you take all the money from the bank, you don't have any invested money in it, it's very risky for the bank to loan you money. On the other hand, if you put 90% of your own money in and only 10% of it comes from the bank, from debt, then it's a very safe investment, but you're not leveraged. Remember, we talk about debt as leverage. You're not leveraged very much, and you don't have to put all that money in if you can get a little bit more from the bank. So when you think about this, what you're trying to do is maximize the value of the firm, and that's not as easy as you think because there's other things. For example, the interest payments on debt you can write off in taxes. So that's a consideration here that we have to think about. So in the capital structure, we want to think about how much debt we want to use, how much bonds we want to issue, and how much equity or stock we want to issue. And that gives us the total value of the firm, so we can take that money and invest it in things like plant, property, equipment, into human capital, etc. So there's one more thing here before we keep moving, which are the stockholders' interests. There's two important questions here. The first is, why should the stockholders care about maximizing firm value? Perhaps they should be interested in maximizing shareholder value. Well, that's not true. They should maximize the value of the overall firm because the debt will have an impact on the overall value of the firm. So getting the share price as high as it can be, that's true, but the fact that they've got debt in the equation magnifies the result of the share price. And then number two is, what is the ratio of debt to equity that maximizes the shareholder value? Well, as it turns out, changes in capital structure benefit the stockholders if and only if the value of the firm increases. So in changes from 50% debt to 50% equity to 60-40, 70-30, those changes, they only are important if it increases the value of the firm. If it doesn't increase the value of the firm, you wouldn't want to do it. Let's talk about some more examples of that coming up.